Taxes on investments can seem really complicated, but actually over 90% of Kiwis don't actively have to do anything to get their taxes sorted. The only two criteria where you have to do some paperwork of your own is if you get a dividend payment of 200 New Zealand dollars or more from an overseas company, or if you invest more than 50,000 New Zealand dollars in cash into an overseas business. There are some other criteria where you might have some tax obligations, such as investing like a trader, where you're quickly buying and selling different companies, only holding them for weeks, days, or even a few hours. I'll show you how you can check if you need to do anything to get your taxes sorted using Kiwi investing platforms like Sharesies and Hatch. Make sure to check out the entire video so you can be certain that you won't be hit with any hidden fees or penalties. First and foremost, I'm not a licensed financial advisor or accountant. Always make sure to seek the help of a professional when you're looking at your investing taxes. So jumping into the first criteria, which is getting a dividend payment of 200 New Zealand dollars or more from an overseas company. So basically, an overseas company is putting your money into any investment outside of New Zealand. Like if you invested into Apple or Tesla or Amazon or any other large American business. So you can say for certain if it's from an American company, you will have to do some paperwork on it. If you're not sure what a dividend is, it's basically a payback to the investors from the company's profits. It's shown as a percentage, anywhere from 1 to 5%. It can be higher than this as well. And some really popular and profitable dividend stocks are Pepsi, Coca-Cola, and McDonald's. If you want to check the dividend amount a company is paying out, a quick Google search will tell you, or on Sharesies and Hatch, it will give a breakdown of the dividend amount a company is paying as well. If you want to see a practical example of how much you would need to invest to get a dividend payment of $200, then looking at a company like Coca-Cola that has a dividend payment of 3%, you would have to invest $6,700 into that company, and then you would get a dividend of $201. So that means you would need to fill in some paperwork of your own. On this graph here, you can see how much you would have to invest for a dividend amount starting at 1% and going down to 5%. So if a company is giving you a 5% dividend, you would have $4,000 invested, then you'll get $200 from it. In comparison to a business that pays out a 1% dividend, then you can have $20,000 invested before you're going to have any tax obligations to meet. With overseas dividends, they're taxed at 33%, so that means that $200 payment, you're gonna lose $66 of it to tax. So at the end of your tax payment, you're gonna have $144 left over of profit that you can keep. One of the biggest things to keep in mind is that it's $200 total, not $200 per business. You can't get a dividend payout of $200 from Coca-Cola and then another from Pepsi. It's the accumulative or the total amount that you get. So what actually happens if you meet this criteria? There's a special form on IRD's website called an IR3 form, which you have to fill in, and it's basically related to any non-taxable income that you receive. Actually keeping track on how much money you're getting from your dividend payments can be pretty time consuming and quite annoying if you went between every company and added up how much dividend payment you were getting to try and see if you were meeting the threshold of that 200 NZD dividend payout. Sharesies and Hatch has a dedicated tab to see if you have any tax obligations. So this includes the dividend payment. It will pre-calculate it for you and show you exactly how much you have. You can see on my Hatch account, I only got a few dollars from dividend payment, so I'm nowhere near having to make any declarations for it. On both of these brokers, it'll also show you all the investments that you've made for the entire tax year, which is from the 1st of April to the 31st of March, in case you need to provide any of this info to your accountant, which can help you with your taxes. So it'll show you all of the investments that you've made, your gains, your losses, your dividend payments, and of course, moving on to the second criteria, if you have invested more than 50,000 New Zealand dollars in cash into an overseas company. So you can see on my tax form with Hatch, invested in an overseas business. So again, the same as with the previous example, any overseas company is one outside of New Zealand, excluding some Australian stocks as well. So this criteria is the foreign investment fund, and the main thing to keep in mind is that it's related to a cash amount that exceeds 50,000 NZD. So if you invested $20,000 into a company and it did really well, it went up 300%, so you got a 3x return, and your initial investment went from $20,000 all the way up to 60,000, that doesn't mean you're going to meet the requirements to do some paperwork for your taxes. However, if you put in $51,000 in cash, then you would have to do some paperwork because you put in more than 50k NZD. So it's not related to the total value of your portfolio, however much that might go up and accumulate. It's related to the cash amount that you put in. Again, if you're unsure, head over to the tab over on Sharesies or Hatch and it'll walk you through this. On Hatch, you can actually pay about 50 to 60 USD and get a foreign investment fund report done for you, but I would personally recommend going with an accountant or a tax advisor that has experience with overseas investments and doing a foreign investment fund to steer you in the right direction. There are forms on IRD's website where you can calculate your tax obligations yourself, but again, going with a licensed professional is going to be the easiest thing. One of the questions I got on a previous video is if you can have $50,000 invested in multiple different brokers before you have to do some paperwork for your taxes. Meaning, can you have $50,000 invested in Hatch and then another $50,000 invested in Sharesies? You can't do that. It's again a cumulative or a total amount of money. So you could have 25,000 in Sharesies and 25,000 in Hatch. That's fine, but you can't have 50,000 per broker. And also the foreign investment fund rules are related to all of your voluntary investments. When you open your broker, put your money into a specific business, you're selecting where that money is going, not the voluntary contributions or mandatory contributions for your KiwiSaver and how that money is allocated through the investment funds that your KiwiSaver has. It's the voluntary ones that you make yourself. So lastly, what are the rules if you're investing like a trader, someone that's quickly buying and selling companies, only holding them for maybe a few days, hours, or weeks? What do you have to do here? Do you have some tax obligations that you need to meet? I actually emailed Hatch and asked them about this because I was thinking of investing into GameStop and I wasn't sure if I was going to make a quick profit because I only planned on holding it for maybe a day or two since it was very volatile, but it looked like it was going to potentially have a really good pump and make some money. I didn't want to get hit with some fees or penalties for doing this. So I emailed them and I asked, and they said that again, it's a gray area. There aren't set timeframes. It's not like if you hold a company for 1 year and then sell it, you have to pay 10% tax, or if you hold it for 2 years, you only have to pay 5% tax. There's not set criteria the same way there is for, say, property, where you have the bright line test, where you have to hold a property for a minimum of 5 to 10 years, and the longer you hold it, the less and less capital gains tax you have to pay. So they didn't really give me a set answer on it, and they said there wasn't really a concrete time frame for it, and it's best to seek again the guidance of a tax advisor or contact IRD directly. So again, keep that in mind. If you're acting like a trader, it's always best to get the guidance of a tax advisor to make sure you're not going to get stung with any hidden fees. Remember, if you find the content helpful, make sure to drop a like for the YouTube algorithm and subscribe to the channel as well. If you're just getting started on your investing journey and want to see all the steps needed to make an investment account and buy your first shares of a company, make sure to check out this video on screen that will give you a complete breakdown of New Zealand's biggest brokerage platform, which is Sharesies.